Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Over her 22 years at Citi Group, Anna Raytcheva managed complex trading risks through volatility regimes both high and low. The Orange County blowup on the back of Greenspan's surprise tightening campaign in 1994 provided Anna with an early lesson on the vulnerabilities that arise from owning exotic securities, especially when they are positioned with leverage. My conversation with Anna considers this and other prominent periods of market disruption and what they taught her about the limitations of modeling. With markets prone to risk on, risk off, Anna sought to develop trading signals using machine learning techniques to detect clues that a change in the vol regime was afoot. Founding Sonya Capital in 2017, Anna capitalized on the perspective she gained trading through crisis periods when liquidity evaporated from markets. As such, she constructs her positions using global futures to implement a discretionary global macro strategy that takes economic data, policy changes, and flows as inputs. We finish our conversation with Anna's assessment of the movement to empower more women in the field of finance. Noting that there's still plenty of work to do, she's optimistic on the opportunities for female advancement in the industry. Please enjoy this episode of the Alpha Exchange, my discussion with Anna Raytcheva. My guest today on the Alpha Exchange is Anna Raytcheva. She is the founding partner and the chief investment officer of Sonya Capital, a firm she founded in 2017 to do global macro after a long career at Citi Group. Anna, thanks for being a guest today.
It's my pleasure. Thank you for having me.
Well, lots going on in global macro for sure. Markets are always changing. We'll probably look back on 2020 as, in some ways, a year to forget, but certainly lots of tumult in various asset classes around the world, just given the sudden stop that hit the economy and just a violent asset price reaction. You have spent your career doing proprietary trading and running teams of traders, first at Citibank, so you spent 22 years there. That's a long time for anyone at a single firm, especially on Wall Street. If we go back 22 years, we see you got your start in the mid-90s. Markets were very different, but certainly were not immune to big risk events. We were just talking about some of the early days in your career of Asian Contagion and LTCM. I'd love for you to just kick off the conversation with a little bit on your own background, how it is you found your way to Citibank and got interested on the trading side. What were the early days in your career? What were those like?
So I started my career in the summer of 1994 at Citi, and I did not study finance in college. I was a math major, but I had heard that math majors get hired on Wall Street. So I interviewed through the Citibank sales and trading program. I had a great experience meeting the traders and salespeople, and I was offered a spot as a derivatives trader on the options desk. So that was July of 94, and within months, the Orange County declared bankruptcy. And the root of the issue there was that their treasury, the Orange County Treasury, owned a portfolio of, among other things, they owned a portfolio of structured notes that had complex coupons. And to compound the problem, they owned them on leverage. When, during that period, the Fed raised rates 200 bips between March and November, and those coupons practically went to zero, and the price of securities dropped precipitously. Now, since they owned them on leverage, collateral got called, led to liquidation of the structured notes, and that was the root of the crisis. I was thrown into this situation very quickly, so I learned how to price structured notes. And the reason investors came to a derivative desk like ours is so in order to value these bonds that had the complex coupons, they would come to a derivatives desk, asset swap the coupon into a floating coupon, and then use that, the upfront cash payment for the swap, as a mechanism to value the bonds. So I was pricing a lot of asset swaps at that time. That was the beginning. But overall, it was the first time I had witnessed the consequences of complex securities and leverage when things go wrong. So, and during my career, I've had several opportunities to experience these type of events.
I was just going to say the Orange County meltdown was obviously very unfortunate especially for the public money that was invested in that. But what a quick lesson for you coming right onto the desk and seeing these violent moves that can occur, especially, as you say, when you embed leverage in these exotic securities. I can recall very specifically the extent to which I think they were inverse floaters. They were kind of squared inverse floaters. There was kind of every permutation of bet that the short rate wouldn't really go up. That seemed to be, was that the most kind of prominent exposure that was being taken at that time in the period right before Greenspan started tightening?
Exactly. So those were inverse floaters. So in general, it's a fixed coupon, less LIBOR times a certain factor. And then when LIBOR started rising fast, the coupon was going to zero. It's floored at zero. So the coupon of the security becomes zero. Now rates are rising. So in a rising zero coupon bond in a rising rate environment goes down very fast.
So that was a quick lesson. And
yeah,
that was fast.
I hope I was clear.
And then, of course, the 90s brought several other big risk events. We talked a little bit about the Asian FX meltdown. Everyone recalls LTCM. What other learning experiences from the early part of your career have kind of stayed with you and were formative for you from a risk philosophy standpoint?
Taking a step back, the late 80s was really the emergence of the field of quantitative finance. And this was the first time that the first swaps were structured, the first CDOs were structured, the collateralized mortgage obligations. And with those new structures, the models to value and risk manage those securities and instruments were developed. And the 90s really became the time where a lot of these models were more widely used and implemented. So from my perspective on this type of quantitative modeling was from the perspective as an interest rate option trader using term structure models to value options. But what I learned during that period is that quantitative models can be very valuable. However, they make oversimplifying assumptions that don't always reflect the complex reality of markets. And when you combine with the fact that the financial system is inherently leveraged, when rare events occur, it's the markets experience a crisis. So there's another instance where, again, during the 90s that experience was the LTCM crisis when, again, it was the models were used as a mean reversion type of models among securities with similar coupons and maturities. But when the Asian crisis hit and liquidity conditions deteriorated, all of a sudden, all these assumptions of the models did not hold. And because a lot of securities were owned in leverage, when the credit lines would start getting called, there was a lot of disruption when those securities were getting liquidated. There were other instances, some of the corporate CDOs experienced periods of like that. But of course, in retrospect, there were crises, but in comparison to the global financial crisis in 2008, that they seem like mini crises. But
with regard to Asia in 97, perhaps it was a precursor to the LTCM blow up the following year. What was your area of focus? Was it trading rate derivatives? I know you've also done a lot on the mortgage side as well.
I was still an interest rate option trader at the time. The 90s, again, during those periods, a lot of innovation occurred in the term structure side of modeling. When I started out, there were price options with a one-factor Black-Scholes model. Then in order to capture the richer dynamics of the yield curve, two-factor models emerged, eventually three factors, etc. then originally the skew rates are very much considered the risk. The rate space was always looked at rates going higher as opposed to lower. So skew originally was skewed towards, with the risk premium towards higher rates. However, so during the Asian crisis, when rates rallied quickly, then that was the first time the skew start shifting, the models for skew start shifting and start repricing the risk towards lower rates at a higher premium. That also coincided at the time with a lot of demand from mortgage portfolio to hedge mortgage convexity. But during that period, I was still on the interest rate option side of the business.
Take us through the period through the turn of the century. So we had a tech bubble. We had Greenspan very worried about deflation, lowering the funds rate, I think down to 1.25% or so, keeping it there for years. And then the emergence of the housing bubble and all the securitization in mortgages and other derivatives built around it. What was that period like for you in terms of proprietary trading? What was the opportunity set that you and your team were focused on? Some of the observations you have from that pre-crisis period.
At the time of the global financial crisis, I was trading for the Treasury. Just by way of background, most banks, they invest client deposits in using high-quality securities, treasuries, and loans. And the securities portfolio sits within Treasury in what's called available for sale portfolio. So during the crisis, I managed a portfolio of high-quality mortgage securities and treasuries for our corporate treasury. So when the crisis hit, it practically brought the whole financial system to its knees, and it took coordinated effort among governments, regulators, financial intermediaries, investors to bring it all back up. My seat gave me the opportunity to witness the process firsthand. But at the core of it, I also look at the global financial crisis as another example of quantitative models for risk, oversimplifying the complex reality. The mortgage credit models prior to the crisis had historically captured well mortgage credit defaults. However, they did poorly after a series of record home price increases that led to material loosening in underwriting standards. In addition, there was innovation on the structuring side, and some of the correlation assumptions in mortgage CDOs, again, assumed diversification when the crisis hit, there was none. So again, that crisis was a combination of complex securities, a lot of risk underwritten under oversimplified or like too benign assumptions. And at the same time, at the time, the system was very leveraged. The leverage among the banks and broker-dealers was over 20. There was a lot of demand from European banks for AAA securities due to the changes in Basel regulation. So a lot of risk was underwritten, a lot of leverage was created, and when the crisis hit, it was very, very disruptive. It was a challenging period, but like anything else, I worked through it, I learned from it, and grew from the experience.
Well, just having a seat like you had during that period, both before it and then through it and then in the aftermath, is just invaluable. And I can imagine that a quantitative trader such as yourself makes use of a lot of data, does a lot of back testing. And I think you pointed to it yourself that there is sometimes limitations in going back and looking at previous periods because there's just different factors at work at a given point in time. You mentioned the role of underwriting standards or the leverage in investment banks. I mean, we would look at those now and be shocked if we saw a bank taking that much risk. But at the time in 04, 05, 06, everyone was okay with it. It's interesting how the system changes. So you were at Citibank through the crisis and then well into the aftermath of the crisis once the Fed got control of things and the system settled down. Give us a flavor on the post-crisis period. You have a funds rate that's at zero for, you'd know better than I would, but several years with a reasonably upward sloping yield curve, increasingly low volatility over the period after the crisis. What were some of the areas of focus for you and your team during that period?
So during that period, as we transitioned to much lower volatility across markets, it was the transition from the high volatility of the market during the financial crisis into the lower volatility. And then also the financial crisis was followed by the European sovereign crisis. So after both of those fairly volatile periods, so transitioning from those into the lower vol environment, call it 2014, 15, so there were a lot of opportunities. And it really was the opportunity set diminished materially during the 2000, I would say 15, 16. And during that period, there were a couple of times in the market that were significant spikes in volatility. One was in rate during the summer of 2014. And then there was another period, 2015, in the equity market. So these were really sudden spikes and deterioration in market conditions. And at that time, I started looking at tools to help me really anticipate or look for, it's hard to anticipate those periods, but at least have some type of indicators that can alert you if markets are likely to shift into high volatility regimes. So some as opportunities, they were few to find, I started working using like basic machine learning types of tools to really try to analyze markets and think about, okay, well, if I were to look for a higher volatility regime, what would I be analyzing and how would I approach that problem? So that's where my work took me, and that's kind of some of that work really gave me the confidence to leave and start my own firm.
Well, I would love to get a little bit more of an understanding of, just from a broad level, what those machine learning techniques might look like. I'd also love to ask you the following. As you were describing this pursuit to try to understand the shift in volatility regimes, oftentimes vol trading is about mean reversion. We see something pop up, and we use the VIX as an example. It pops up from 20 to 30, and more likely than not, it constitutes a decent sale at 30 as things settle down and mean reversion takes place. However, as we've seen with something like the global financial crisis, or even this year with the pandemic, you go from 20 to 30 and you're on your way to 80. So there's certainly the potential to step in way too early. I'm curious, just with that as a starting point, I'd love to get your thoughts on just thinking through maybe the false positives in changes in the vol regime. How do you kind of sort those, kind of signal from the noise type of effort? How do you think about that in terms of detecting changes in vol regimes?
So the first insight that the shifts in vol regimes are fairly persistent. So once you shift above a certain level, you stay there. I think on its own, once you're there, you have to look for other sources of information to determine, are we going from 30 on the way to 50, or are we going to 30 on the way to back to 15? And I think at least the tools that I've been using, there's a limitation. They're not predictive to which way you're going. At that point, I try to look at other sources of information, whether it's, well, what is the cause of that shift in volatility? Because let's say a situation like end of 2018, that shift in the volatility was more technical. It was related to year-end selling pressure, let's say, versus a situation in March where there was a fundamental shock to the system. So it's much harder to predict how long the volatility will stay elevated. In fact, in end of 2018, once some of the flows get digested through the system, the expectation is that we can revert to our lower vol regime. I haven't found that one tool in particular is valuable, but the combination, I try to source information from different tools.
I was just, as you pointed out, the increase in rate vol in 2014. I think we had that Treasury kind of up crash in October of 2014. 2013, we had the taper tantrum with Bernanke surprising the market with the notion that the Fed actually would start to taper its purchases. And that was kind of a unique risk off sponsored by higher rates, which really was the motivating factor. And in some ways that happened again at the end of 2018 with Powell somewhat talking past the market, at least from the market's reaction standpoint. I'm wondering, just from a signaling standpoint, if there's anything specific about correlations that make their way into your process that you found to be a source of information, maybe stock bond correlation or any signals that rely on not just asset prices themselves or the volatility, but also their degree to which they're either moving together or moving in opposite directions?
Yeah, so usually during periods of higher volatilities, correlations among assets goes up, and that's a continuous process. So if you track that transition, as correlation among assets goes up, it's usually correlated at the same time with higher volatility. So there is information in how correlations change. But sometimes it can be contemporaneous, so it's not informative. But it's definitely something I track.
So you successfully decided to spring out on your own after a long and successful career at Citi Group, founding Sonya Capital. Tell us about your venture and your motivation for founding your firm and what the core investment philosophy is at a high level, and then we can drill down into some of the trading techniques and tools that you use, the risk management protocol that you employ. Love to hear about your founding of the firm.
Venturing on my own to found my firm, it tells a little bit about how I make decisions, and pretty much I felt I had an edge in giving it a shot. I could see the upside in terms of being able to developing a strategy that will attract capital. And finally, I felt I was doing something that I was passionate about and willing to do the work and face the challenges that come along. And the reason I felt I had my edge is because having managed several desks at Citi, I started several strategies from scratch, felt comfortable that I could build a firm in a controlled and cost-efficient manner and build in a way in a sustainable fashion. And really, it was important for me that it's both control and cost-efficient to ensure sustainability. As I mentioned, I had already begun implementing some basic machine learning techniques in my process, and I wanted to see where that takes me. And also, having seen multiple crises during my trading career, I thought that was unique. And that experience, it's hard to come up. As I mentioned, pretty much started at the beginning of the quantitative finance emergence, and then I've seen a lot of models and frameworks get tested in the process, and you learn through those processes. And then the upside in the strategy is because it was important for me that the strategy was liquid. So having gone once through the financial crisis and just seeing how liquidity can disappear intraday, not even overnight, intraday, as market participants get nervous about valuations or liquidity in general, it was important for me to execute the strategy with listed instruments. So the strategy is executed with global futures, that it's liquid. When you have a liquid strategy, it's also very scalable. If I were successful with the strategy, with the parameters I had set, for the strategy, I felt there will be demand from investors. And the goal for the strategy was really to, of course, the strategy targets 10% volatility, and we seek to achieve about 1 Sharp. And overall, like 1 Sharp, it's not a particularly high Sharp. However, when you look at the 60-40 portfolio, has a 0.6 Sharp, and the more relative value strategies have over higher Sharp, like 2 and higher. However, they're limited in capacity. So I set out to develop a strategy that has over 1 Sharp, which is materially higher than, let's say, a passive 60-40 portfolio. At the same time, it's scalable. So I felt if successful, there will be demand for this product. And finally, as I mentioned, I love trading. The first day I stepped on the trading floor, I fell in love with it. So I feel very passionate about markets. For me, markets are the most fascinating, complex, dynamical system. They encapsulate the actions of many market participants, individuals at the level of the economy. And I also find satisfaction in figuring out how information and ideas propagate through the system. So I really love markets and trading. So that was kind of in a roundabout way to sum it up. Like I felt I had the edge. I could see if I was successful, the upside in scaling the strategy, and I was doing something that I love.
One of the things we touched on is this notion of correlation. And certainly it appears that your strategy has sought to, and I think been successful in delivering return, but delivering so in a way that's broadly uncorrelated, or certainly as a low correlation to the S&P. And that's really hard to come by. How much of that, just in terms of your portfolio construction, is something that you're targeting and that you see as kind of valuable to the end user, to the allocator of capital, to Sonya? How much does a product that doesn't have that natural correlation to something like the S&P that many other assets do?
So it's not something that was targeted ex ante, but the way we construct the portfolio, the universe of instruments we trade is, because we trade liquid futures, our universe of instruments is somewhat limited. And when we look for opportunities in that universe, the first priority is constructing a diversified portfolio. And to that end, we analyze the instruments and we seek to identify lowly correlated themes. Now, during that process, so we seek to identify the lowly correlated themes, and then we evaluate each theme and its suitability for the portfolio. But during that process of identifying these lowly correlated themes, because equities are naturally correlated among each other, by definition, they occupy like some percentage of the portfolio, but it is not as large as, let's say, 60% exposure in, let's say, a passive portfolio. So some of that low correlation may come from that. Another reason is we do invest time in thinking about, well, when is it likely that the market is shifting into higher volatility regime? So that's part of our tool set as well. So we do try to anticipate these more volatile periods and have been successful on several occasions.
There's a lot of ways to come at the job of portfolio construction. Some are very, very quantitative. Others are steeped in bottoms-up fundamental research, some top-down macro research. How much of your process is informed by macro research? Is that a main part of it? Is it just something that you observe? Give us a sense as to how portfolio construction is implemented.
So as I mentioned, once we identify the themes, then we have a set of tools to help us determine, is a particular theme right for positioning. And as part of the inputs that go into those tools are what most macro traders use: macroeconomic information, investor flows, price technicals. So when we select the themes, we by and large rely on our quantitative tools to help us filter the themes that are right for positioning. I do read also a lot of macroeconomic research, but that's more as part of my surveillance work. But the themes themselves that get selected for the portfolio is that process happens when I primarily weigh the input from the quantitative tools at my disposal. Some of that's macroeconomic information, some of it's flows, price technicals.
I wanted to get your take on central banks. We talked a little bit about the outset with Greenspan tightening really quickly in 94 and that catching a lot of people off guard. It's sort of the opposite effect now. It's how much can central banks ease? We've seen some prices that most of us would never expect could exist. I think the German bund yield got down to maybe minus 70 at the high point in price. How does someone like you account for what is inarguably just a tremendous amount of impact from not just the Fed, but every central bank is just heavily involved in some ways in setting prices or interacting with securities markets directly? That's not the climate in which you started the industry. I'm curious just over time how your investment process takes note of and accounts for the impact of both the actions and the words of large central banks like the Fed.
My view on central bank is probably in minority among traders, but the way I view central banks is by and large, they use the same information as macro traders. They analyze macroeconomic data, they source information from their business contacts. But unlike a trader that's looking to generate P&L, they target financial conditions. And as such, from my perspective, I think central banks react to what's happening in the market and are not necessarily the driver. But because they're, in a way, the tools available at their disposal to address, let's say, financial conditions imbalances they're limited. Their tools are limited and they're known to all the participants. Their behavior is predictable to a large extent. Now, what happened, I think them getting involved in supporting asset prices, etc., that I feel like this was what happened in March and how aggressively they came to provide market liquidity given the situation. My feeling is that part of it was lesson learned from the financial crisis, where it took longer to stabilize secondary prices, and it meant the recovery was much longer. But I'm not sure if that's a change, if this aggressive action this time around was prompted from the view that the pandemic was an exogenous shock, where there's a lot of the rhetoric, well, it's no one's fault, etc., and whether under different conditions they would behave in the same fashion. It'll be interesting to see, like, under different circumstances, it's possible that the reaction function is different.
Well, certainly the central banks have become more and more prominent, and so has technology in the world of trading. And just I'd be curious, over the course of your many years in markets, we've seen so much development in the world of trading. And I certainly remember in the early days of the U.S. listed options market, there was no electronic trading at all. And now you have effectively bots just making markets all day long in relatively large size. So technology is a force in markets. And I'm wondering, just in terms of how you've implemented that as part of your investment process, can you give us some sense as to the big drivers from a technology standpoint over the last several years and how the sort of changes in the technology landscape have made their way into your investment process? I know you've talked about machine learning and artificial intelligence. Tell us more about that.
First, I cannot pass the opportunity to give listeners a context of where technology was when I started. At the time where we ran risk using an application called Lotus 123, which was nobody has heard about it.
Oh, I have.
You may know what I'm talking about, but it's sort of like the precursor to Excel. And at the time there was Excel, but it's not what it is today. I mean, to run our interest rate options book, that was an overnight exercise, which now you can, for this type of risk, you probably have live risk. Every morning, as a junior trader on the desk, every morning I would get a printout of the risk and all the trades printed on a dot matrix printer, delivered on a continuous form paper, which is like this stacked paper with holes on the sides. And I would manually check all the new trades to make sure everything was booked correctly. And the whole process was very manual. And as you pointed out, execution was done over the phone. If you just track the markets overnight, we had pagers that would stream. There was a tape of the futures prices. And only the most senior traders got the pager. Not everybody got the pager. And not to mention like the clunky workstation with the desk prompt. So it was just a very different environment. But because technology wasn't as advanced then, by doing all the process manually, I learned a lot. So that was, I think it added to my learning experience. But fast forwarding to today, the technology benefits are huge, both on the operational and the investment side. So I run a fully outsourced model for compliance, back office and middle office, and IT support. The firm that provides our back office and middle office support for us, it's called Hatchbacks. I use their software application, and it's straight through processing for trades and allocations. The positions and trades get reconciled at the end of the day electronically, and it's very limited human involvement other than reviewing the output. We've also benefited from the public cloud technology. So all our IT systems are in the cloud. So that, at the time, like 4 years ago, when I was making that decision, it wasn't widely popular or widely used, but in retrospect, turned out the right decision. But on the technology advances on the investment side, where, at least from my perspective, what I found the benefits are really in the computational power of the machine. So on my machine, I can run easily Monte Carlo simulations. I have data machine learning software, different data analysis, machine learning software. And then also the access to data is very easy, largely thanks to Bloomberg. They've done a tremendous job in collecting a lot of data and making it available to their clients. So what technology does for me, it allows me to organize the information better and iterate through trade ideas faster. And I can also simultaneously analyze multiple geographies and asset classes with the tools available to me. As I mentioned, I also run Monte Carlo simulations to understand better the portfolio risk under different correlation regimes. So all this work is done very, very quickly. So that as a trader, the quicker the analysis or the output from the analysis, the more iterations you can do and the more you can improve the decision-making process. But I also don't want to mislead by saying, like, we're not a heavy-duty quant shop. We use technology to organize the information, but by and large, how we weigh the input for all the quant tools is really, it's a discretionary process. And our approach to global macro, even though it does use quantitative tools, it doesn't rely on using big data and heavy-duty algorithmic trading. So I just want to make sure I clarify that.
One of the threads I think throughout this conversation so far is just the kind of speed with which markets can shift in terms of a benign environment that suddenly becomes something more toxic where vol is exploding and you find people in this kind of forced deleveraging stance. And we live in this world of liquidity that's either on or off. And there was a period of time, again, in this coming into 2020 where people were concerned increasingly that there was an underestimation of the degree to which liquidity could suddenly shut off. And that's really what happened in March. For good reason. Obviously, we had never tried an economic shutdown as we did in March. And so it's clear that there's going to be a massive amount of volatility in markets. I know you're in global futures, so you're on the liquid spectrum of instruments, but how do you guard against the potential that markets they're just prone to these liquidity shocks? We've seen it time and time again. What are the techniques that you use to guard against the potential that the vol regime just suddenly shifts and liquidity declines markedly?
The observation is spot on. We get to this period where liquidity evaporates very quickly. And the question is why? And I think there's two reasons. One is related to valuations, and the second reason is, at least on the listed side, is how orders are executed. On the valuation side, as we discussed, for a variety of reasons, excess savings or structural deflationary forces or central bank actions, real long-term rates have been very low. Now, these low interest rates are embedded in the valuations of all asset classes. But more importantly, the distribution of these real long-term rates is skewed towards higher rates. So periodically, the market begins pricing higher real long-term rates. They overshoot, and the volatility in the rates gets reflected in all asset classes. And that's really a valuation argument. When the market starts repricing higher rates, it's pricing much higher rates until, let's say, central banks step in to normalize those rates or other market participants step in to provide liquidity. The other reason is what I have observed on the liquid future side is the algorithmic execution. So from my vantage point, I would say that the market impact from execution is actually, it's larger than it used to be. And in situations, sometimes when there is idiosyncratic flow, the market would, let's say, gap, but price will recover quickly. So if you're looking at prices on a close-to-close basis, not much happens. But if you track the tick-by-tick data, you can actually see the flow getting processed through the market. So at the end of the day, for idiosyncratic flow, there is no price impact. While when there's structural flows in the market and market risk need to transfer risk, and the larger market impact from algorithmic execution is much more pronounced and leads to higher volatility and less liquid conditions. So that's something I've observed. In order to, again, adjust to this, it is what it is. We have to take the market for what it is, not what we wish it to be. So we have developed a lot of tools to really identify those periods where there is material risk getting transferred. So we've shifted towards relying more on our flow tracking tools and technical tools and less on what I would say is more fundamental macro investing. So staying closer to the flows in a way helps us navigate this new market environment. And it's possible that changes. Those are the conditions that I observe for the moment, but it's possible it changes in the future.
When we think about the movement in an asset, it's typically the market's processing some new information, perhaps that it was unprepared for. That's the kind of first part. And the second part is maybe the amplifier of the positioning is the accelerant. So you get a vol event where the world is short vol, something like that. How effective is the pursuit of positioning and trying to understand where trades are potentially overly sponsored, where there's kind of too much capital in one particular theme or expectation? How difficult is that, or does that make its way deeply into your process? the sort of goal of understanding how the market's positioned ahead of something?
The positioning, I track positioning, the data that's publicly available, so I track that. But what I use to get a sense, really for our purposes, when we have certain themes in the portfolio, what I try to assess is like, has this theme already priced in? Is it already in the market and likely run its course? And for that, and I hope this doesn't sound funny, but I do scan, like that's what my Twitter feed is for. So I scan financial sources, bloggers, posts, etc. And I do this on a daily basis. Like I scan a lot of information just to get a sense in aggregate, what are the themes that are top of the mind for, let's say, the market participants in aggregate at a high level. So I know I've seen some research that certain people try to use machine learning type of algorithms to identify sentiment in markets, etc. I do it manually. I just scan through the information. But positioning, because in terms of positioning, there is data, but sometimes positioning can perpetuate an existing trade. And sometimes if there is exogenous information, it can lead to liquidations. But positioning on its own, I haven't found to be indicative for prices.
This has been a great conversation, and I really want to thank you for taking the time. You are one of the very few females who has founded a hedge fund, and you've been a prominent part of the investment community at a senior level for many, many years. I'm curious if you can just give us some of your take on just the increasing opportunity set, hopefully, for women in finance. It's the traditional trading roles have been filled by men, and just it's a male-dominant industry. I'm wondering if you can give us a sense as to whether you see progress on the front of advancing the cause of females in our industry. What does that look like to you?
I see progress, I have to say. I think it's a great time to be a female professional in the industry. There's awareness and willingness to create more gender equality. And there are many successful role models. So for young professional women, there's always a question, well, can it be done? Well, there are enough role models to demonstrate that can be done. Again, as a percentage, they're not huge, but they are. The role models are there. I also, what I've observed over the years, diversity has been, for the large banks and money managers, they've been working on the diversity issue pretty much for the past 20 years, if not more. And I think they're beginning to see the results of those efforts. Most organizations have programs to mentor and support young, diverse talent through their ranks. And if somebody has an opportunity to join one of those organizations, I'm fairly certain they're going to have a very good experience. On the investment side, I want to highlight the efforts by the 100 Women in Finance organization. They've taken concrete steps to help minority-owned firms raise capital. It's a goal their CEO said a few years ago, Amanda Pullinger. She said, I want to move the needle. It was very clear. And they have been, this week was actually their Fund Women Conference. It's in virtual format, but it has the largest attendance ever globally, and it was a tremendous success. So again, they're making tremendous effort to move the needle on that front. It's the first step. It's going to take time. It's not going to happen overnight. But even on the investment side, I see there's a lot of willingness from different participants to make a difference there. I'm optimistic. I'm very optimistic.
That's great to hear. Well, Anna, I want to thank you for being a guest on our podcast today. I'm sure our listeners will value your insights, and your career path is quite inspiring. So thanks again, Anna, for taking the time.
It was entirely my pleasure. I appreciate the opportunity, and I'm be looking forward to the next guest.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.